Hi, I'm Mark Farber, and this is the Accounting Fundamentals videos. Today we're going to talk about transactions and what is a transaction essentially. Before we do that, I want to talk first a bit about accounts and what we mean when we say accounts. Accounts are obviously important in accounting. It's where the name accounting comes from. And you can think of an account as nothing more than a file. If you use file folders, accounts are essentially file folders where we keep similar data. So we could have one file folder for all of our assets, one file folder for all of our liabilities, and keep track of them that way. We tend to have a lot more accounts, and the more accounts that we have, the more detail we're going to have in our data. So we would have accounts, for instance, for cash. That would be an account. And we would keep track of how much cash the company has. We might have an account for equipment. So every time that the company purchases some equipment, we would record that in the equipment account. Similarly, there'll be an account for bank loans, where we would keep track of how much bank loans the company has. And so a company can have as many or as few accounts as it wants with certain limitations. Essentially, you try to find the right number. So let's park that for a second. What is a transaction? When we talk about a transaction in accounting, what do we mean? Well, essentially, it means that any time one of these accounts changes, any time we do something that's going to change an account, or more specifically, is going to change either an asset, a liability, or an equity amount or account, then we have a transaction. So if you buy something, well, you're going to spend cash. That changes an asset. And you're going to acquire some sort of asset. Maybe it's equipment that you're purchasing. If you take out a bank loan, then you're going to get cash, and you're going to incur a liability, a new bank loan. So that's going to change accounts. Whereas other things don't necessarily result in a change in one of these accounts. So for instance, if I hire somebody to work for the company, well, on the day that you hire them, you don't owe them any money. You don't have to pay them. You've simply entered into a contract that they're going to do work for you in the future, and you in turn are going to pay them at the end of each pay period, whether it's weekly or monthly or whatever. So that's not a transaction until they actually do the work and you actually either pay them or at least owe them the money. So why is all of this important, and why do I have the accounting equation, which we're going to see a lot of in the next little while, over here? Well, when we have a transaction, one of the key things to keep in mind is that there's always two parts to every transaction. And if you've been looking at the accounting equation, that should make sense to you. If we do something that, let's say, increases the amount of cash in the business, cash is an asset, so that's going to mean that our assets increase. Well, if our assets increase and nothing else happened, this equation would be out of balance. So in order for it to remain in balance, one of a few things has to happen. If we have an increase in cash, and we'll just put a little dotted line here, we either have to have a corresponding decrease in another asset account. So one asset goes up by $20, another asset goes down by $20, nothing changes. Or if our cash is increased, then a liability account has to increase. So for instance, if we borrowed $20, we have a liability of $20, the company owes $20, and it has $20 of cash. So this has gone up by 20, this has gone up by 20, and we remain in balance. Or, if it wasn't an increase in liabilities, it would be an increase in equity. So every time we do a transaction, we have to go back to this equation and make sure that it remains in balance. Make sure that we've identified the two parts to that transaction and that we've properly recorded them such that at the end of having recorded the transaction, this is still in balance. If it's not in balance, then everything else falls apart after that, okay? And as you can imagine, that's rather time-consuming and painstaking work to make sure that every time you do something, this remains in balance. So we'll see later on that there are, in fact, tricks. But in our next video, what we're going to do is take a look at a few transactions and just trace through the effect that they're going to have on assets, liabilities, and equity accounts.